here's the uncomfortable truth most people don't like to hear. If you own stocks, you are betting on the future behaving nicely. If you own bonds, you are betting that it won't. And right now, both sides are nervous. Because for the first time in a long time, the rules that made stocks feel safe and bonds feel boring are quietly breaking. This video is not about picking sides. It's about understanding the machine underneath both of them. Because once you see how it really works, you stop asking which is better, and you start asking a much more dangerous question. What happens if neither works the way we expect? Let's start with why this matters right now. For decades, the advice was simple, almost boring. When you're young, buy stocks. When you're older, move to bonds. Stocks grow, bonds protect. They balance each other out. Except, recently, they didn't. In 2022, stocks fell hard. Bonds fell too, at the same time. That wasn't supposed to happen. Pension funds panicked. Retirees were confused, and people who thought they were diversified realized something unsettling. They owned different assets, but the same risk. To understand why, we have to strip stocks and bonds down to their core. Not definitions, not textbook diagrams, but what you're actually buying. When you buy a stock, you're buying a story about growth. Not the company itself, not the factory, not the employees. You're buying a claim on future profits that may or may not exist yet. That's it. If the company grows, earns more, dominates its market, your slice becomes more valuable. If it stagnates, gets disrupted, or mismanages itself, your slice shrinks. Stocks are promises about tomorrow, and promises are fragile. They depend on consumer spending, on technology behaving, on politics not interfering too much, on interest rates not rising too fast, on competitors not getting smarter. Stocks feel exciting because they live in the future, but that also makes them nervous, neuroreactive. Now, bonds. Bonds feel boring because they are the opposite. When you buy a bond, you're not buying growth, you're buying a schedule. You lend money, you get paid back, with interest, on specific dates. No story, no dreams, just math. Governments issue bonds to fund deficits. Companies issue bonds to fund expansion. You lend them money and they promise to pay you back. In theory, bonds are about certainty, but certainty has conditions. And this is where things get interesting. Because bonds are not risk-free, they just hide their risks better. The biggest risk in bonds is not default, it's time. Imagine this. You buy a bond that pays 3% interest. Sounds fine. Then inflation rises to 6%. You are still getting paid, but your money is losing value faster than it grows. You didn't lose money on paper, but you lost purchasing power in real life. That's the quiet risk of bonds. They don't scream when they fail, they whisper. Now, here's where stocks and bonds secretly connect. Both are priced based on interest rates. Interest rates are gravity in finance. When rates are low, money floats. When rates rise, money falls. Stocks fall because future profits become less valuable when discounted at higher rates. Bonds fall because new bonds pay more interest, making old bonds less attractive. Different assets, same pressure. For years, interest rates were near zero. This created an illusion. Stocks went up because money was cheap. Bonds felt safe because inflation was low. Everything looked stable. But it wasn't stability, it was suppression. Low rates compressed risk. They pushed investors into assets they didn't fully understand. They rewarded optimism. They punished caution. And when rates finally rose, reality snapped back. That's why stocks and bonds fell together.
not because they are the same, but because they were built on the same assumption that cheap money would last forever. It didn't. Now, let's talk about the math people avoid. Stocks don't grow because companies are magical. They grow because earnings grow faster than inflation over time. Bonds don't protect because they're safe. They protect because they're predictable. But predictability fails when inflation becomes unpredictable, and growth fails when costs rise faster than profits. This is where hype meets reality. The hype says stocks always win in the long run. The reality says the long run depends heavily on when you start. If you invested in stocks in 1929, it took over 20 years to fully recover. If you invested in Japan in 1989, you waited decades. Stocks are powerful, but timing matters more than people admit. Bonds, on the other hand, are sold as conservative, but long-term bonds can lose massive value when rates rise. In 2022, some government bonds lost more than many stock portfolios. That shocked people because they were taught the labels, not the mechanics. Now, here's the irony. Stocks feel risky because prices move every day. Bonds feel safe because prices move quietly. But risk isn't volatility. Risk is failing to meet your future needs. And both assets can fail in different ways. Stocks can collapse suddenly. Bonds can erode slowly. One hurts fast, the other hurts invisibly. Now, zoom out. Why does this matter beyond your portfolio? Because entire systems are built on the assumption that stocks grow and bonds stabilize. Pensions rely on this balance. Insurance companies rely on it. Governments rely on it. When both sides wobble, the system strains. That's why central banks care so much about markets, not because they love investors, but because markets are plumbing. If bonds break, borrowing costs explode. If stocks collapse, confidence disappears. And confidence is the real currency. Right now, we're in an awkward transition. Inflation forced rates higher. Higher rates exposed hidden fragilities, and investors are relearning old lessons they forgot. That safety is contextual, that growth is conditional, that labels lie. So, stocks versus bonds is the wrong framing. The real question is this: in a world where money is no longer cheap, inflation is unstable, and growth is uneven, what does safe even mean anymore? Because once you stop assuming one asset will save you from the other, you're forced to confront something much more uncomfortable. There may be no default answer, only trade-offs. And the hardest part isn't choosing between stocks and bonds. It's accepting that both require you to be wrong about something and live with it. So the next time someone tells you stocks are for growth and bonds are for safety, ask them one simple question: under what conditions does that stop being true? And if they hesitate, that's your answer.